There is a bridge in Japan that engineers have studied for decades, not because it's impressive, because it shouldn't still be standing. It was built with one critical flaw, a structural assumption that everything connecting it would hold under normal conditions. And for years it did. Then one unusually cold winter, a single support beam contracted just a few millimeters more than the model predicted, and the entire eastern span had to be shut down for emergency repairs. Nobody noticed the flaw during construction. The inspectors didn't catch it. The computer models approved it because the models were only designed to account for the conditions they expected, not the ones they didn't. The global economy works the same way. Right now, the financial systems connecting every country on Earth are built on a set of assumptions. That trade flows will remain relatively stable, that debt will be repaid on schedule, that energy will stay affordable, that the institutions holding everything together will hold. And for long stretches, those assumptions are correct. Until they aren't. This is a story about the hidden architecture beneath the world economy, about why it's far more fragile than official reports suggest, and about what happens when the wrong piece shifts at the wrong moment. The illusion of stability. Open any major financial institution's annual forecast and you'll find the same language. Words like resilient, measured, gradual, manageable. It's not dishonest, it's structural, because the institutions producing those forecasts are themselves part of the system. They have every incentive to project calm. But beneath the language, something more interesting is happening. The global economy has spent the last 15 years operating under conditions that have never existed before in recorded financial history. Interest rates were held near zero for over a decade in the world's largest economies. Central banks purchased trillions of dollars in assets to prevent collapse. Governments borrowed at scales that would have been considered catastrophic in any prior era. These weren't small adjustments. They were experiments, large-scale interventions with no historical precedent and no guaranteed outcome. And here's what most economic commentary skips over. When you intervene aggressively enough to prevent a collapse, you don't eliminate the underlying fragility. You often delay it. Sometimes you amplify it. Because the debt doesn't disappear. The imbalances don't resolve. They just get moved around, repackaged, and absorbed into the next layer of the system. Think of it like a pressure valve. You release enough tension to keep the pipe from bursting, but the pressure is still there, and the pipe is older now than it was before. How interconnected systems actually fail. Most people imagine economic crises as explosions, a dramatic event, a single visible cause. In reality, they look more like avalanches. An avalanche doesn't start with a mountain collapsing. It starts with one layer of snow shifting just slightly beyond its threshold. That movement transfers weight to the next layer, which transfers it to the next, and then at some point the whole face releases at once. The 2008 financial crisis followed this pattern almost exactly. The surface narrative was subprime mortgages, but the actual mechanism was a chain of dependencies that nobody had fully mapped. American homeowners defaulted. That triggered losses in mortgage-backed securities. Those losses hit balance sheets in European banks that had no direct exposure to U.S. housing, which froze interbank lending, which stopped credit from flowing to businesses in Asia that had nothing to do with any of it. One layer, then the next, then all of them at once. What made it so destructive wasn't the size of the initial shock. It was how deeply the system had become interconnected, and how few people actually understood the full shape of those connections. That interconnectedness has only deepened since then. Today, the global supply chain is more concentrated than at any point in modern history. A handful of geographic choke points move the majority of the world's manufactured goods. A small number of financial institutions sit at the center of global credit markets. And in critical sectors like semiconductors, the entire world's production capacity runs through fewer factories than you could count on one hand. This is called concentration risk, and it's the quiet flaw in the bridge that nobody put in the inspection report. The debt architecture nobody talks about. Here's a number that tends to get mentioned once in a financial article and then quietly forgotten. Global debt across governments, corporations, and households. now sits at roughly 3 times the size of the entire global economy. That ratio has never been higher. To understand why this matters, you need to understand what debt actually is in a macroeconomic sense. It's not just money owed. It's a claim on future economic activity. When you borrow, you are making a bet that tomorrow's economy will be productive enough to generate the income needed to service today's obligation. For decades, that bet paid off. Economies grew, incomes rose. Debt was manageable because the future kept delivering what the present had promised. But that equation requires one thing above all others: growth. And growth, particularly in the world's largest economies, has been slowing structurally for years. Demographics are aging. Productivity gains are harder to find. The easy phase of globalization, where adding new workers and new markets could reliably lift output, has largely run its course. This creates a tension that doesn't resolve itself naturally. You have debt levels calibrated for a higher growth world, sitting inside an economy that is gradually becoming a lower growth reality, and the gap between those two things doesn't stay theoretical. Eventually, it shows up in credit ratings, in refinancing costs, in the willingness of lenders to roll over existing obligations. The mechanism doesn't have to be dramatic, it just has to be persistent. And it is. 3 shocks that could change everything. Fragility doesn't announce itself, but you can identify the pressure points where external shocks are most likely to find the structural weakness. There are 3 worth understanding. The first is energy. The global economy runs on affordable energy with a reliability we have stopped consciously noticing. The price of oil isn't just the cost of filling a tank. It's embedded in the cost of manufacturing, food production, transportation, and industrial output at every scale. When energy prices spike sharply and stay elevated, the effects don't stay contained to the energy sector. They move through the entire cost structure of the economy like a temperature change moving through metal. The 1970s showed us this. The 2022 energy shock in Europe showed us again. And the world's energy infrastructure is not meaningfully less vulnerable to supply disruption today than it was then. The second pressure point is the US dollar. This is one that financial institutions discuss in careful, measured tones, because the alternative is to say something that markets might actually react to. Roughly 60% of global foreign exchange reserves are held in US dollars. The majority of international trade contracts are denominated in dollars. When countries need to buy oil, settle debts, or access global capital markets, they largely do it in a currency they don't control. This arrangement has enormous advantages for the United States. It also creates an invisible dependency for everyone else. A sustained shift in confidence around the dollar, whether from fiscal concerns, geopolitical realignment, or the gradual expansion of alternative settlement systems, wouldn't just affect American markets. It would require the entire global financial architecture to reorganize itself around something that doesn't yet fully exist. That process, if it ever begins in earnest, would be extraordinarily disruptive. Not because dollars would become worthless, but because the transition itself carries risks that no current model is built to fully absorb. The third pressure point is the least discussed and arguably the most immediate. It's the commercial real estate market. Following the shift to remote work, vacancy rates in major commercial properties across the developed world have reached levels not seen in decades. The buildings aren't just empty. They're sitting on bank balance sheets as collateral for loans that were written when those buildings were worth considerably more. Regional banks in the United States are particularly exposed, and regional banks are not peripheral to the economy. They are the institutions that lend to small businesses, to local developers, to the layered economic activity that doesn't make financial headlines, but drives a significant portion of employment and growth. This isn't a hypothetical risk. It's a developing situation being managed quietly and carefully by regulators who understand exactly what a disorderly outcome would look like. Why the official responses tends to arrive late. There's a pattern worth recognizing across every major economic crisis of the modern era. The warning signs existed before the event. Sometimes, in 2005 and 2006, there were people inside the financial system raising serious concerns about mortgage underwriting standards, about leverage ratios, about the structural assumptions baked into credit ratings. They weren't ignored because the data wasn't available. They were ignored because the system had enormous momentum in the direction it was already moving. This is one of the less comfortable truths about how economic institutions function. The incentive structure of financial markets rewards participation and penalizes early caution. A fund manager who reduces exposure 2 years before a crash doesn't get celebrated for foresight. They get fired for underperformance. And regulatory bodies, whatever their individual competence, operate within political and bureaucratic systems that have their own constraints and timelines. Crisis intervention tends to lag the crisis, not out of negligence, but because the mechanisms for response were designed for the last emergency, not the current one. By the time the official language shifts from resilient to concerning, the pressure has usually been building for a while. What this actually means for ordinary people. None of this is an argument for panic, and it's certainly not a prediction of imminent collapse. Fragile systems can persist for a long time. The pressure valve keeps working until it doesn't. And economic history is littered with crises that were widely predicted and never arrived exactly as described, alongside others that arrived from directions almost nobody was watching. But there's a practical way to think about this. Economic fragility doesn't primarily threaten the people with the most resources. The wealthiest individuals and institutions have the flexibility to reposition, to hedge, to absorb losses, and wait for recovery. The people who bear the sharpest cost of systemic disruption are consistently the ones with the least margin. The families without savings buffers, the workers in the most cyclically sensitive industries, the businesses operating with the thinnest cash reserves. Understanding the architecture of fragility isn't about predicting the next crisis. It's about understanding that financial systems are human constructions, built on assumptions that can change, that stability is a condition, not a guarantee, and that the decisions made at the individual level, about debt, about savings, about risk, exist inside a larger structure that most people never see clearly until something goes wrong. The bridge stands until it doesn't. The question isn't whether the model is flawed. The question is whether you know which assumptions the model was built on. There's a phrase economists use that rarely makes it into mainstream coverage. It's called a Minsky moment, named after the economist Hyman Minsky, who spent his career arguing that stability itself is destabilizing. His idea was simple. The longer a system operates without crisis, the more confident participants become. That confidence drives them to take on more risk, more leverage, more exposure to the assumptions they've stopped questioning, and gradually, the system drifts toward a fragility that no individual actor intended and no single decision created, until something small shifts. And then, everything does. Minsky died in 1996. His ideas were considered interesting, but peripheral for most of his career. After 2008, economists started calling what had happened a Minsky moment. The phrase has been used several times since. The question worth sitting with isn't when the next one arrives. It's what assumptions you're currently not questioning, because that, historically, is where the answer tends to be hiding.